Fed is no longer engaged in quantitative easing. They are now engaged in quantitative tightening. We'll go over what that means and how it can have an influence on the housing market, making sure you have the bottom line. Good morning. Looking at housing information over the past week, we see that applications for purchases, when it comes to mortgage applications, were up 1% week over week, but that still puts us down 16% year over year. Now, the average rate on a 30-year fixed did fall to 5.43%, which represents the biggest drop in mortgage costs since 2020, so pretty significant. Now, when we talk about application data and interest rates, what we're looking at is information provided through the Mortgage Bankers Association and the survey that they complete called the Weekly Mortgage Application Survey. They've been completing this survey since 1990. It's an indication on the overall housing market and mortgage financing activity. And the way it works is this survey reflects information provided by a pretty wide array of retail and direct mortgage lenders. What's important to keep in mind is it does not take into account information from mortgage brokers. It's the Mortgage Bankers Association. So mortgage brokers are not providing data, and the reason that's significant is that if you look at a wide comparison between wholesale rates through mortgage brokers and retail rates, you find that mortgage brokers are far less expensive. As a comparison, when they did this broad study to look at the difference between the two, you see over $9,400 more being charged on the retail side compared to a mortgage broker. So the reason we mention that is it's important to keep that in mind when you hear average rates. That doesn't necessarily mean that's the rate one person would get for their situation. It's going to depend a lot on the company that they work with and also their personal situation. So, speaking of rates and some of the factors that influence them, we talked last week about the Fed and the increase in the Fed rate. And that's a big headline, and that's typically the component of the Fed that people pay the most attention to. A component they don't pay as much attention to is something I mentioned, quantitative easing, quantitative tightening. What does that mean, and how does it influence things? So, back in early 2020, when there was a lot of concern over many things, including the state of the economy, the Fed began engaging in quantitative easing. This is also something they've done in the past. It's a tool that they have. Essentially, they're purchasing assets, and one of the major assets they purchase is mortgage-backed securities. Mortgage-backed securities are the bonds that underlie mortgage interest rates. They drive interest rates higher or lower depending on that activity with mortgage-backed securities in the bond markets. So the Fed, engaged in quantitative easing, buying these mortgage-backed securities, is going to pressure interest rates lower and has a pretty significant impact. Now at this point, they're reversing course, right? Because we're fighting inflation and the Fed is taking a different course of action. So they're engaged now in something called quantitative tightening. That means they're actually selling off assets on their balance sheet, including mortgage-backed securities. This is going to pressure interest rates higher. So we don't know exactly where things are heading moving forward with rates, but it's fair to say there is definitely a possibility that we see rates increase over the course of the next year. And we'll keep you closely posted on how that goes and what you can expect to see. Now, another important thing that the Fed is looking at that's going to dictate their activity, how much do they hike rates and what kind of action do they take, is unemployment data. And Jake, tell us where are we at right now with unemployment and what do we need to know about that?
Yeah, absolutely. So the thing to know about unemployment right now is that if you just watch the rate of unemployment, you would think that things haven't changed at all and we're doing totally fine. Ever since April 2022, the unemployment rate has stayed stagnant at 3.6, which is quite low. However, all of the metrics that are around the unemployment rate that would have an impact on the unemployment rate are not looking so good. So for example, we have reports that new job openings fell by 600,000 in the month of June, and that makes on a 3-month total of a decrease of 1.2 million jobs. Additionally, the number of hirings have fallen for a 4th straight month. The hiring rate just fell to 4.2%, which is the lowest since January of 2021. The unemployment rate has now become, again, one of the most important monthly data points that experts are looking at, along with CPI, Because basically, if you classify a recession in the traditional sense of 2 consecutive quarters of negative GDP, then we would already be in a recession. So the experts are keeping a really close eye on both the unemployment rate as well as these different factors that are going to have an impact on it to be able to confirm where we're going and make that official determination if we are in the recession. At the same time, we have the number of opportunities dwindling as well as spending on expansion and hiring also decreasing.
Yeah, so definitely a really important factor to keep an eye on, because the jobs market and our unemployment rate affects our entire economy in a big way, especially the housing market, not being immune to that effect. So something we want to keep a close eye on and keep you all in the loop as far as what we're seeing. We're trying to look beyond the headlines, right? And understand details on where things stand and some of the nuances to give us a better understanding of where we're at. Now, speaking of that, we want to look quickly at home price appreciation. Home price appreciation over the course of the past couple years has been incredible. It's been a huge number. Year over year, people are seeing massive increases in the value of their home and the equity they have in their home. Rates are higher. The market is changing. And so what does that mean for home price appreciation? What are we going to see? Again, we can't predict the future accurately to exact detail, but we do want to give you all the information that we have and what we're seeing. Now, there's pretty broad consensus that we're going to continue seeing home price appreciation, but at a much slower rate than we have over the past few years. And so we want to talk a little bit about what that could look like. So let's give an example. So say you have 4% appreciation over the course of the next year in home values. And I'm just throwing a number out there that is not my projection. But if you have an appreciation rate that's a lot more moderate, like 4%, well, what does that mean for homeowners? The thing that influences this is when you own a home, you have the ability to take advantage of leverage. Leverage meaning you can take debt out against the property, specifically a mortgage, right? So you buy a $400,000 house, you put down 10%, and that home appreciates 4% year over year. That's an increase in value of $16,000. However, your return on investment, or your cash on cash return for the money you put down to the increase that you got in the value of your investment, is a 40% return on investment due to that leverage. So something important to keep in mind when you look at home values, that leverage, and looking at the overall economic benefit and difference really between that and the alternative, which is going to be to rent. So those are the most important pieces of information and topics that we saw this week we wanted to bring to you in this week's episode of The Bottom Line. Every week on Friday, we're going to be bringing you the latest information that's out there on the economy, and more specifically, we're looking at housing. Where are we at? So we'll continue to bring you that each week. We appreciate you tuning in and hope you have a great day.